Let's talk about transfer pricing for a few minutes. In a large, diversified company, one division will often buy products or components from another division rather than buying them from an outside supplier. The price charged for the internal sale of a product between two different divisions of the same company is known as a transfer price. The transfer price becomes the sales revenue for the selling division and the cost for the buying division. Therefore, the operating income, ROI, sales margin, and residual income of each division will be affected by the transfer pricing that's used. Setting a fair transfer price is often difficult because each division will want to maximize their own profits. So the selling division will want the price to be as high as possible, while the buying division will want the price to be as low as possible. Vertical integration is the practice of buying other companies within one supply chain. It's predicated by the notion that a company's profits can be maximized by owning one supplier. So this chart here determines or summarizes strategies used to determine the transfer price. So if you use market price, it's usually viewed as fair by both parties, meaning the buying and selling division. The disadvantage is that it can only be used if an outside market exists. And then other considerations, the market price could be reduced by any cost savings occurring from the internal sale. For example, they're saving marketing costs if they're selling internally. Negotiated price allows division managers to act autonomously rather than being dictated by a transfer price set by top management. Disadvantage is it does take time and it can lead to friction between division managers. And negotiated transfer price will generally fall in between on the low end, just covering variable costs, to market price on the high end. There's also a possibility of a cost or a cost plus markup, and that's useful if market price is not available. The selling division has no incentive to control costs, though, so a fair markup may be difficult to determine. And several definitions of cost could be used. Again, are we using variable cost? Are we using full costing, etc.? In addition to the strategies on the previous slide, management should consider the following factors if the divisions operate in different areas of the globe. Do the divisions operate under different taxing authorities, such that income tax rates are higher for one division than the other? Would the amount of customs and duties be impacted by the transfer price used? If either of these situations exist, then management will want to carefully craft the transfer price to avoid as much income tax, customs, and duties as legally possible. So as you can see, setting an optimal transfer price involves careful analysis. Keep in mind that internal sales should only be encouraged if the company overall would profit by the exchange taking place. This additional profit is usually the result of cost savings that occur from the producing the product internally rather than buying it in the open market. Any transfer price selected is simply a mechanism for dividing this additional profit between the buying and selling divisions.